I am your host, Charles Dobbins, the founder of the Multifamily Investing Academy and the Multifamily OS system to creating your multifamily real estate business. And I'm here today on my award-winning podcast. You guys need to know that.
We already know that.
I'm honored.
I know, isn't that cool? I can't believe that. I mean, one time I took a picture of myself holding up the award, sent it to a buddy of mine. He says, "You look surprised." I said, "You obviously haven't listened to my podcast lately." Okay, we got Anthony Faso, who's a CPA, which obviously means we have to bring the other guy, Cameron Christiansen, in, who's got the personality.
Exactly.
Yeah.
Charles knows the game.
Exactly, of course I do.
Yeah.
They're founders of Infinite Wealth Consultants and hosts of the Infinite Wealth podcast. Anthony is a proud U.S. Army veteran and self-described recovering CPA. He's worked at the world's largest accounting firm and served as a CFO at a chain of restaurants. However, after the 2008 recession, when he was probably still in elementary school by the look of it, he realized that the solution to financial freedom would never be found in the latest Wall Street created financial product. Amen, brother. As he was discovering what his path to financial independence would look like, he was also teaching and coaching individuals and business owners about money and investing. Having been a small business owner for 8 years, he was frustrated. Oh, Cameron. Now we're on the other guy.
Yeah.
Now we're talking about the good-looking guy.
Yeah,
Cameron was one of the guys that I trained.
He's lying, Charles. He's
Yes. Oh, he just wouldn't go away. Cameron, you got to go home. I can't keep.
Trust me. I'll get him back.
He can hold his own.
Yeah. All right. After advising others for over a decade, Cameron now brings his expertise in passive income generation and cash flow analysis to his partnership with Anthony.
Yeah.
As followers of the principles of Robert Kiyosaki.
Never heard of him, huh?
Never heard of the bum. Rich Dad, Poor Dad, Anthony Kiyosaki. They help their clients be financially independent, not just in dollars, but also in cents, S-E-N-S-E. They educate their clients on making sound financial decisions and coach them on investing in assets that have certainty, control, and collateral. Okay.
You got me pumped.
Wow.
Oh, I know.
I don't know if anybody's read that whole thing.
I'm done. We're done. We're done for the day. Okay. So first off, you're calling it infinite wealth. And then you also tout the fact that, be your own bank. All right. You know how it is. I tell it like it is.
Yeah,
and when I heard that, my first thought was, are you guys selling life insurance?
And
You'd be right.
First thought's correct. You got
Nailed it. I mean, you're not going to ask me those really challenging questions like within the last 2 years, have I engaged in motorized racing, scuba skydiving, hang gliding, ballooning, ultralight flying, mountaineering, or rodeo riding, or intend to do so?
I'm not, but somebody else might.
Okay. Yeah. Okay. Then we got it. Okay. So listen, you got to break this down for me. Because I really want to talk to you about how this works. Because this is like, let's say I'm sitting on $500,000 of cash. I am, 60 years old. So I know. I tell everyone I'm 72, but I'm actually only 60 because I don't get compliments when I tell people I'm 60. I get compliments with anything I say too. But how? Relatively good health, take the typical statins, high blood pressure stuff, and I own a bunch of real estate. What would you recommend for me? Let's take a $500,000 liquid.
Yeah.
First, I'd recommend all the conceptions that you have of life insurance. You need to put them to the side. This is very different because really, when I first heard about this, I thought the same thing. This sounds crazy. I just totally didn't understand. When I had my CPA firm, life insurance guys would come to my office all the time.
And you know what you would recommend? You know what you would recommend, Mr. CPA?
Buy term, invest the difference.
That's all you should. See, I sold life insurance. My father was a life insurance agent for 57 years. And when I was selling it, oh God, don't even get me back to those days. When I was selling it and they say, oh, I got to go, pitch to somebody's CPA. Every CPA was what we call the termite. You were a termite. Yep.
Yeah. And I was the same way, but as I alluded, as you read in that great introduction.
I wrote that, by the way.
That
Okay,
long,
yeah.
long introduction. Yeah.
2008 really kind of
It
changed
was, it was too long about Anthony. I know that.
Yeah, I know. That's what I meant. Yeah.
or it was too long about Cameron, to be
Kim-
No,
honest. I
no,
thought.
no.
Yeah.
We got a lot more to read about Cameron, you know?
Yeah.
So go
Yeah,
ahead.
do we?
Like an onion,
Yeah.
peeling the layers.
But I tell people, this ain't your mama's whole life. This design is very different, and this design is, you can really put the death benefit aside. Let's just say it's not even there. Let's just focus on the cash, right?
Okay,
If you're
so two things.
Yeah.
First off, not every company sells this type of product, right?
you're right, yeah,
Correct,
Like I
yeah.
can't go to my New York Life agent and say, "Hey, I'd like to buy this." They'll look at me with wondering what I'm talking about, right?
no, what they're going to look at is they're going to see the commission dollars, right?
Yeah.
Because there's
Oh,
different,
tell me about it.
Right.
Yeah.
And they'll tell you they can do it.
yeah, exactly.
Oh, okay.
Right.
Okay.
Because our design is different. What is the way like your mama's whole life is designed, maximize death benefit. You don't have any cash value really till year 3, and the agent is paid a high commission on the total premium.
Yeah.
Our design is the exact opposite. We're designing to try to get as much cash as possible, and we have cash that you can turn around and use 30 days later. Death benefit is much less, and so is our commissions. Their commissions are about 3 times higher the way that we design it. And so a lot of companies can do it, but the thing is, you need an advisor who is knowledgeable, for one, how to design it properly, but then also how to help you execute it when you're investing into real estate.
Okay, so let me ask the second question.
Yeah.
Is you talk about the death benefit, and even the fact that we are talking about the death benefit, whether we maximize it or not, you still have to underwrite the policy and qualify for it,
Yeah.
right?
Mhm.
Yeah.
Are they, I mean, are you looking for strictly preferred risks?
No,
Don't care.
Can you do substandard, but then it kind of kills the deal?
Nope.
it doesn't kill it at all, Charles. So Anthony said you got to set those conceptions aside, right? So
Okay.
you're viewing it from the insurance lens, right? So lens, when you're looking at insurance, is, hey, the rating is paramount because that gets us the cheapest and most amount of insurance. That's not what we're doing here. Literally, all we need to do what we do is we need an approval. That's it. So whether it's preferred, standard, substandard, it doesn't matter. We did a podcast. We get that question so often that we did an entire podcast. We devoted an hour to it. And what we talked about was that if you're a 20-year-old, a 40-year-old, or a 60-year-old, and you implement and design a policy the exact same way, the same dollars and premiums, what you'll find is the cash value across the board on those ages at your year 1 mark, your year 10 and 20 mark is virtually identical. The factor that changes is going to be the amount of insurance that somebody can purchase at those certain ages.
Okay.
So again, right, at a 20-year-old, maybe you get $1 million of coverage. 40-year-old, maybe you get 500. 60-year-old, maybe you get 250. But when you
on what kind of premium that you're using in this example, like say when I got to the 60-year-old, and you're only giving me $250,000 of life insurance, did I just dump $200,000 into the plan?
Nope, you put $10,000 into the plan.
Wow. Okay.
Yeah.
Wow. Okay.
Yep. So you put 10,000 in, and you've got, I don't know, 6,500, something like that in cash value.
Okay. Yeah. All right. So I guess what you're trying to tell me is that what you guys have done, I see you and you collectively in this side of the life business.
Mhm.
What you have done is you are using the tax advantage benefits of life insurance as a vehicle, but the insurance is secondary. In other words, you're just saying, oh, it's going to grow tax deferred. You can borrow it at this rate. And so explain to me how, if I'm right, and if I'm right, explain to me how that works.
Well, what I'd say, if we tie it down to, probably a lot of your listeners are real estate investors, right? And what they're probably, they need to store their capital in between deals somewhere, right? And typically they're storing it in somewhere that's safe and liquid. And then when a deal opportunity comes, they withdraw the money and buy the asset, right? And so they're typically looking for safe and liquid, which they're typically using a bank is typically where they store the money. And then they buy an asset. That asset produces cash flow or some sort of return. They have to put it somewhere. They put it back in the bank. And then they build up enough in the bank to buy another asset. And then that produces cash flow. They got somewhere to put it. And all we're really saying in the simplest terms is there's a better place to store that money that is not only cash and liquid, but it's going to grow at a higher rate of return. That's going to be tax-free. And in most states, in every state, there's some level of asset protection. So you can put the money somewhere liquid, safe, and protected. And what we're showing, and we can prove mathematically, that storing it in a high cash value whole life policy is a better place to store that cash. We're still going to buy those same assets, but the advantages of putting it into this policy we're going to have uninterrupted compound interest, because the way we're able to utilize this, we put the money in the policy. We don't withdraw. In the prior example, if we're using a bank, when we deploy it to buy an asset, we drain the account, right? And we break the compound interest curve. Okay. But what I'm saying is, if by using this system, instead of draining the account, we use it as collateral and we borrow against it, and we use those funds to buy the asset. And then we use that asset to repay the policy. And in essence, what will happen at the end of the day, we still have the asset, but because we stored our money in life insurance as opposed to a bank, we never broke the compound interest curve. So that money is continuing to go up a little bit each year. And I tell you what, we often say that this is our rewards credit card for investing, right? Now, Charles, do you use rewards credit card?
I just got a notification on my computer from Citibank a moment ago, like while I'm on the call with you, about my rewards. So yeah, of course I do.
Perfect. Okay. Now, why not just pay cash instead of, why you use a rewards credit card?
Yeah, I know, because I use somebody else's money.
Yeah, and
for a period of time.
Yeah, but then you need to pay that off, right?
Yeah.
But by doing that, you do get a little free access to money, but mainly it's just like you got that email. You get some bonuses, you get some miles, right?
Yeah.
If you can understand that, you can understand infinite banking. All we're saying is, when I go to buy real estate, I wish I could use my rewards credit card, but instead of paying cash, I use my policy. And then the advantage of doing that, as opposed to a credit card, instead of getting miles, I'm getting uninterrupted compound interest.
Okay.
So
now, go ahead. I'm sorry. Go ahead. Finish your thought.
No, I mean, so that's really the simplest place. I mean, if we really tone it down to simplicity, that's really all we're talking about, is where investors are storing money. And particularly in this time right now, we're seeing the volatility of the banks. It's even more important to have some money in somewhere that is safe and liquid.
All right. So you talk about designing the policy and what have you. Like, who owns the policy? Who has to be the beneficiary? How do you guys structure all that? Is it a single premium plan, or do you how does that work?
Oh man, yeah. Let's start with a single premium. So single premium, for all intents and purposes, kind of went away, right? So insurance companies used to have single premium options, but that is really no longer an option available anymore.
Okay.
But what I would tell you is that there's always a workaround, Charles.
Yeah.
So
there's an exception. As the only thing I learned in law school, Cam, and I'm going to teach it to you right now, is there's an exception to every rule except for one.
Was that death?
No, there's an exception to every rule except for one.
I lost it. What do you got?
Well, my brother Lenny is listening right now, and he was the one that figured it out first when I came back from a law school classroom. The only rule that has no exception
Is
the exception to every rule except for one.
Okay.
okay. I got
so
you.
You guys found the exception.
Yeah, but thanks for walking me through that very slowly, Charles. I appreciate that.
That's
Hold
okay.
my hand.
I needed to be walked through it too the first time myself.
Charles, now
nice.
you know how I feel trying to
was
teach
nice.
the banking of this
Listen,
guy.
no,
It's
I just have no
painful.
shame. I'll tell you if I don't understand it.
He just gets him in the door. You just close him.
Exactly.
Yeah.
All right. So we got single premium, not real, typically no longer allowed, but there are workarounds. And so we do have a design that we call a one and done where, and the reason that we came up with this was really for real estate investors. They come into windfalls. They have large amounts of cash and capital. It's really difficult to get that amount of money into a policy without running into these MEC limitations.
Right,
and for your listeners, what that means is that you put too much cash into a policy, you lose some of the tax advantages. And so the design
MEC stands for maximum.
It stands for modified endowment contract.
Modified endowment contract. Right. Okay. Yeah.
And that came in the early 80s. The IRS came in and put a cap on how much cash you can put into a singular insurance policy. And so there are limitations that are set on the top side by the IRS, and on the bottom side, they're set by the insurance company. So our design, what you're asking about is, hey, how do we do this? And so we do have a minimum that we need to address for the insurance to make sure that we keep everything under this kind of umbrella tax-free, the growth and the distributions. But then on the top end is the IRS has given us limitations where we may lose those tax advantages if we put too much cash into it.
Right.
Yep.
Right. Okay. So who owns the policy?
So you own the policy, the individual. So,
okay. So all right. So we don't have to set up a structure where it's owned by a trust or something to that effect.
In most cases, we don't. The only time that we do is if there's a estate planning issue, like we're worried about the estate tax. But other than that, there's no real advantage of putting it into a trust.
Okay.
As long, but I will say that I have policies on my kids and policies that I own on myself, where I'm the insured, the trust is a beneficiary, and I'm the owner.
Right.
But in policies where I'm not the insured, for example, I have a policy on Cameron. The owner,
good thinking, buddy. Good thinking.
Yeah.
Well, no, good thinking on my end. I got one on him. He's 10 years older than me.
Yeah. you never know by looking at you, buddy. I tell you. Oh, look at Cam. He's getting all mad now.
Yeah. No. He's supposedly, he thinks he's a good looking one, and I'm the one with glasses. But policies that other people are insured, like on Cameron and my kids, I have my living trust own it.
Right.
And that's just more simplicity to avoid probate. But I might be getting a little more detail than what your question was asking. But in essence, I'm the owner of the policy. I control everything, and I can choose who the insured is on. If I am unhealthy and maybe I can't qualify, I just need to have an insurable interest, or really a financial loss if somebody were to die. And then I can put a policy on them, and the beneficiary can be whoever I want. And so, but typically, again, for estate planning purposes, I have the living trust being the beneficiary.
Yeah. All right. Now, you guys are brokers, right? Or do you work for one particular company? Like, I was a New York Life agent, and I was, that was how does it work in this world? What companies do you represent? Is there one big mainline company that provides this type of product?
There's a bunch of companies out there, right? And each year what we'll do is we'll go out there and we'll start to vet companies on certain criteria and make sure that they fit the bill, right? So if you're asking which ones we use or what the criteria is, I'll tell you the criteria first, and then I'll tell you who we're using. How's that?
Yep.
Is one of the first things you want to look for when you're choosing companies, Charles, is you want to make sure they're a mutual company.
Yep.
Right? As opposed to a stock. And the reason for that is that at the end of the year, the mutual companies, when they realize a profit, they will redistribute that profit back out to the policy owners. right? So if we can participate in that distribution, that's great. That distribution is called a dividend. You want to check the dividend history of every major mutual company that's out there. Make sure that they're paying dividends, make sure that they're healthy. The next one is you want to check out the financial stability of these companies, right? There's several different rating agencies out there that they will look and rank these companies on. Probably the easiest one, if somebody's listening, is a Comdex score. The Comdex score companies are rated from 0 to 100. So you only want to work with companies that are in the upper 10%, so 90% or higher from that Comdex score. And then the last one is...
Hold on. I have never heard of a Comdex score in my life.
Well, that's...
Yeah, when did they start using a Comdex score to...
I don't know when, but it's in essence just like an average of the rating agencies, and then they try to kind of put them like on a weighted average from the most solid is 100 and then the least solid is 1. And then so you can kind of see how they relate to each other.
You know, this probably came about after the 2008 crash. You know, if you watch my most favorite movie, God, I can't even remember the name of it. But
I know what it is, and I can't think of it, The Big Short.
Yeah, Big Short, The Big Short. When he went in to talk to the woman from AM Best, and just really pretty much showed the world how crooked those agencies are. They probably came up with a Comdex score after that, just to do like a blend of all the different rating agencies.
Well, I tell you, I don't know when they started the Comdex score, but that can be an easy way to evaluate companies on a high level.
Cam's Googling it right now.
I am. I'm trying to find this for you, right?
Because I'm telling you, I've never heard that before. That's interesting.
Best thing about so Comdex scores, I can do two things at once. Comdex scores
I can't.
Are important, right? You want to make sure you're working with the ones that are financially secure. The last metric that we usually share with clients, Charles, is we call it IBC friendly, right? So infinite banking concept is something that some insurance companies have embraced, and some insurance companies have said, no, thanks.
Yeah.
And they'll do it blatantly, right? Well, they'll send a statement out that says we want none of that business, or they'll do it subtly. And the way that they subtly will do it will restrict access to your own money.
Oh, okay.
And or they will charge kind of excessive interest rates on some of the policy loans.
Okay, so I was thinking that you're going to give me a different answer for that. I was thinking you're going to tell me that they do it subtly by making it not an attractive commission product for their field force, and that's why they don't really sell it all that much. I mean, that's what I'm picturing New York Life. I'm guessing because I just converted a bunch of term a few years back, and my agent gave me a whole big sales pitch and all the different products. And I had heard about this concept, and she never presented anything like this, which made me think that New York Life's not one of the companies that you guys are dealing with. Am I wrong?
You're right. I mean, that is not one that we do work with.
Yeah.
Part of it is flexibility. So to kind of finish that first touch up is that there's two things you want to look at when somebody kind of embraces infinite banking. One is you want to look at the design, and the design really comes down to the PUA rider, the paid up additions rider, which is the cash portion of the policy.
Yeah.
And you want maximum flexibility on that. So one way the insurance companies will kind of say, hey, we're not doing this, is they limit their flexibility with the PUA riders. Hey, can we max it out 1 year? Can we take it to 0 the next? And then
I don't think New York Life would ever give it. You just check the box when you fill out the application, what to do with the mutual dividend. I'll buy paid up additions, and that's all you do.
Then the other one I'll say before we touch on dividends would be that the loan provisions on the policy. The loan provisions on the policy it's just stated in the whole life contract. So you need to read and understand those before you put that into place. And once you read those and you start to read several different companies, you'll realize that they do vary a little bit. And so you want to make sure you work with a company that has 0 restrictions on loan provisions, right? You don't have to wait your first year. They don't have excessive interest, stuff like that. And so that's how you kind of get through. So there's 4 or 5 metrics for you. But really who we're using, I would say, is probably Penn Mutual, Mass Mutual, One America, Lafayette Life. Am I missing anybody here?
So, yeah.
SML.
The interesting, these are probably life insurance companies you never heard of.
Well, hold on. SML, is that State Mutual?
That's Security Mutual Life out of New York.
Okay. Wow. Yeah, they are. I've heard one of them, obviously Mass Mutual, but
Well, yeah, we heard of Mass, but what is interesting, all of these other companies, one thing Cameron failed to mention, all of these.
Yeah, I can't wait for this show to be over. I mean,
Okay.
Me neither.
I'm having a good time.
Yeah.
Is all the companies we work with are over 100 years or older.
Yeah.
And they paid dividends every one of those 100 years.
Yeah.
So that is going to exclude many companies. And there's not a lot of profits in whole life. So a lot of the stock companies do not sell it. I mean, they're selling different forms like index universal life or some of these variable lives, which we're hugely not fans of.
Yeah. Interesting. All right. So listen, just because I help out my former brethren, you insurance agents, who's your best prospect? Give me your avatar.
Real estate investors.
Okay. Any particular ages? Do they need any particular amount of cash to make this worth their while? Like, how does that work?
What I would say, I mean, the more cash you have, the more opportunities we're going to have to invest. But I'd say a lot of who we work with we work with some experienced investors, and we work with a lot of newbies that are just new to this and trying to learn. So for our clientele, what we really want to work with somebody who is teachable, right? They're willing to learn new things, because if they're going to work with us, we're not going to just tell them what to do. We're going to put them through our education process so they understand what and why we are doing this. So they need to be teachable. And then most importantly, they need to be able to take action. There's a lot of people who get educated, but then just always sit on the fence. But if you're teachable and ready to take action, that is people that we want to work with.
I'm going to add something else on there, Charles, that Anthony missed. Is that right?
You knew this was coming. You knew this was coming.
The reason,
I did.
The reason that real estate investors are good clientele for us, and that's who our book of business really is because they think differently. Right? I would say, for better or worse, most of the people out there do not want to take control of their personal finances, and they're looking to outsource that piece to it. Real estate investors have taken control over it. They know exactly what they're going to go do with it. And so what I would tell you is there's some really easy things that we can do with infinite banking and insurance to increase the returns and help them to pay less in taxes. So they're already doing stuff that maybe some of these newbies want to do. And what we can do is come in and just help them be a little bit more efficient and end up with more money at the end of the day.
Interesting. All right. Hey, just give me a little bit of background on your pedigree. Like when you came out of the service, Anthony, did you go right into insurance? Or you did the CFO for the restaurant company for a while. Mm-hmm. How did you get into this racket? Did you go to work for one of the career companies and then just kind of learn the ropes that way? It's
interesting. I remember watching Wall Street. Do you remember that in the 80s? Yeah. And I wanted to be a stockbroker, was kind of what I want. But then I went in the Army, and I really don't know why I picked accounting, but I always had a passion for learning about finance. And when I had my CPA firm, I was working really closely with my financial planner, and I was actually about to get licensed with him and do joint work. But then 2008 happened, and I said, you know what? I don't have the stomach to tell people you did everything right, but to no fault of your own, your 401k is now a 201k. I just couldn't. I couldn't do it, and then I realized something was wrong. I mean, there's this recession or correction every 10 years. And I figured if I didn't do anything different, why would I expect a different result? So I went looking more selfishly for myself. how am I going to live the life I want and be able to have the wealth I want? I can't follow Wall Street. I need to figure it out myself. So that's when things kind of clicked. And I found this concept from a book called Becoming Your Own Banker by R. Nelson Nash. And then I read Rich Dad, Poor Dad and kind of combined the two together. And here we are. Interesting.
So, I mean, but you were about to get licensed, or you thought you were going to work with a financial planner. Yeah. What was he with any particular company, or did you just go right out on your own as a broker?
Well, you know what? I didn't have any intent of becoming. Oh, what was interesting? Actually, a guy from Mass Mutual recruited me and said, "Hey, if you get licensed, you refer me business. You're referring them anyways. You get licensed, I can pay you a commission." And I'm like, okay. And I'm actually getting licensed when I discovered this concept. And the guy who showed it to me wanted me to work with him. And I'm like, you know what? I already talked with Mass Mutual. And he's like, let's talk about this concept, because I wanted to become your own banker. I want to do infinite banking. And so this was in 2009. This was right before Cameron heard about this concept. And so there weren't a lot of mentors to really, I'm going to give digs to him,
No, but he heard about it when he was cleaning the office of that financial planner.
Yeah, exactly. Yeah, that was his business. So back then, nobody was talking about it.
Just jump on the bandwagon.
Yeah,
jump on the Christiansen bandwagon.
Kick a man while he's down, Charles. That's all right. I can take it.
Yeah.
I mean, it's going to be my turn at one of these days if Anthony stops
and
yapping.
we're out of time. Thanks for coming, everybody.
So he worked for an independent firm, our own one. So that's where I started learning this process, and that's when I took Cameron under my wing.
Oh, I was just about to say, well, wait a minute. So Cameron was the guy that took you under his wing. Yeah, now I get it.
No. I took Cameron under my wing, and then eventually we kind of wanted to run things our own way and wanted to have our own business. So we kind of branched out on ourselves, and so we are independent. We don't work with one insurance company. We work with the one that's going to be best suited for your situation.
Folks, you've just heard from the Jerry Lewis and the Dean Martin law firm.
Wait, who's Dean Martin? We got to know who's Dean Martin, who's Jerry Lewis.
We got Desi Arnaz, for crying out loud, and one of them. My gosh. Yeah, look at him.
And Lucy.
To his Lucy. Yeah. All right. Hey guys, how do we get a hold of you? How do we get it? So anybody listening, because I got to be up around 200,000 downloads by now, and I'm just scratching the surface. But how do they get a hold of you? You guys are in Vegas, aren't you?
We are in Vegas, but our practice is 100% virtual, Charles. So
yeah,
we've been doing that for 5 years or so. But
awesome.
It is awesome. You can reach us, infinitewealthconsultants.com. You can go there. That takes you everything. We'll provide you kind of a link tree to everything that we have, all the social media out there where you guys could book a meeting. But also, Charles, right, if anybody's listening and they have questions, we have an online course that we've built out for exactly this. So somebody can go in there, look around, look at some of the case studies, some of the examples that we have in there. There's nothing salesy. It's all education. And so if you guys want that, it's going to be infinitewealthconsultants.com /Charles Dobbins.
Oh, cool.
Right. Cool. And so that we can add that.
Dobbins right.
Yeah. We'll put that in the show notes so they can go in there, look around. And then there is a link in there. If somebody actually wants to kind of schedule something, they can schedule it and put it on our calendars there.
What I would say in that course, many of the videos on there, one of them is buying real estate or whatever the asset is in cash or running it through a policy. And we kind of do the math to see who has more cash at the end of the day, and more importantly, why. And also, Charles, you alluded before to buy term and invest the difference.
Yeah.
We did the math on that.
Yeah.
And instead of buy term, invest the difference, if you buy whole life and invest the cash value, we ran the math and you have 50% more money at the end of the day. And that's because That's because of the uninterrupted compound interest.
Ouch. Ouch. Guys, sometimes, you're leaving me on a low note. Like, you're making me hurt right now because I didn't know you 3 years ago. I mean, but now I gotta get your word out for, it's like what that crazy man Grant Cardone says, if you don't know about me, shame on me. So we got to get your message out the door as well. So
Thank you, Charles.
guys, Anthony Faso, CPA, and Cameron Christiansen. We're still trying to figure him out. And but guys, give them a buzz. InfiniteWealthConsultants.com. Check out their links in my show notes and give them a buzz. Give them a buzz. You'll talk to anybody, right? Of course you are. You're an insurance agent. You know what Woody Allen said? Some people think there are worse things in life than death. And he said, have you ever tried to spend an evening with an insurance agent? That was Woody Allen. So yeah, I use that one.
Well, imagine throw a CPA on there.
Yeah.
Oh, I know.
Just
Oh my
total
gosh.
excitement. Total excitement.
Yeah, and you're the only CPA I know that doesn't have the bedside manner of a CPA, Anthony, which it's not a stretch.
No, but I take that as a compliment.
Yes, it was. All right, guys, great to see you, great to meet you, and good luck to you. And let's keep talking.
Charles, thanks.
Go make it a fantastic
Talk to
day.
you
Take
soon.
care.
Bye-bye.